Interact with a lot of youngsters when we do these financial awareness sessions. I simply ask them a question: how do you select a good fund? And their answer is, we Google it.
And probably they choose it based on the past returns,
Absolutely.
which is absolutely not the right way.
Absolutely. That's the whole idea. I wanted to talk about how one can select a fund, or one or two criteria they should look at before investing in a mutual fund. Because definitely not the way you search a restaurant, best Chinese food in the city, because looks like they're doing in that direction. So best performing fund, and the algorithm throws up the last year's best performer. And then what happens next 6 months? Not necessarily that fund remains the number one. They get confused and they exit from the fund and re-enter into the fund which is number one at that point in time, and again it changes. So I want to ask two questions here. Is that one is that, can a single fund remain number one forever? And then of course, how do they select? What are the two criteria they should put before selecting a good fund for themselves, according to you?
Yeah. On the first question, it's an easy answer. No fund can remain number one forever. So no fund can remain there. No stock can remain there. And we do invest into stocks. So no stock can be the top performing all the time. And similarly, no fund can be the top performing all the time. All that you need to do is, what is the pedigree that you are investing into? What is the fund house pedigree? Whether there has been a stability in the fund management team, what kind of experience that the fund management team brings, how have been the cycles in terms of the fund performance in the past. It's no indication of future performance, but it does give you a guidance in terms of how they manage certain cycles. I'm not talking about daily volatility, but if there are very big events that have come and gone, how have those phases been with respect to fund performance? That's also very crucial. And also they need to meet somebody like you to understand what kind of risk each portfolio is taking. I don't think it is easier for them to understand the risk that each portfolio is taking. If they just go by outcome, usually higher the risk, potentially higher the return.
Okay.
Right? Potentially. It can also lead to very low returns, but the risk levels that you take in the portfolio also lead to some amount of returns in a good market. But it has to be optimum level of risk. It cannot be higher than what you can chew. Right? So these are some of the things. It's difficult for any investor, so I'm not making it more complicated. I think ideally they should sit with financial expert and understand that and choose the bucket. And also it depends on if you want to invest 100, whether you want to put all eggs in one basket. Okay. It may not be one single fund, but if you're picking all funds from a same category, more or less you're going to take the same risk, whether that's the optimal risk or not. So those are the things that they need to understand. I would say, clearly, going by past returns is absolutely the wrong way of selecting funds. Like, for example, in any sport, if you believe that what has happened in the previous match is going to repeat in the next match, that may or may not happen, right? So even in investing, it's the same case. While all of us try to be close to what we can optimally at all points of time, it may not be possible all the points of time. So that's where, if you look at the long-term track record, you will see whether on a overall basis, whether a fund has managed to do that or not, whether there has been a consistency in the team or not, whether there has been a coherency in terms of the portfolio construction or not, and what kind of risk that portfolio has taken to deliver that risk. For example, let's say a fund takes X level of risk and delivers 12% returns. But if you are another fund which takes 2x level of risk and deliver 18%, if you just simply look at returns, past returns, you will say 18% delivered fund has done better. But on a risk adjusted basis, per unit of return that comes for a per unit of risk is more important. So actually the first fund has delivered, let's say, a certain level of risk adjusted return. The second fund has been lower because it's taken 2x the return risk, but has delivered only 1.5 times the returns. Right? Okay. That is also important, because otherwise, when things go bad, the funds which have taken higher risk are the ones which are going to underperform.
That's a great insight. And in our research also, we kind of look at the process, the fund management team, and the longevity of the fund management team, that may be difficult for somebody coming from a different background to do all the research. If I have to give them one single point, is just not to go by the past immediate last year return. Also look at during bad times how the fund has behaved. This can be one of the important points they can keep in mind before selecting the fund.